Longer-term bond yields in China have moved down a crazy amount over the last month, but now short-term bond yields have utterly crashed. And over the last couple weeks, China's one-year bond, for example, has moved down 50 basis points just since December 9th, with most of that move coming last week alone. So the obvious question or questions in all of these plunges that we keep seeing, like Brazil's real, is why and why now? The why now is really the one to focus here on China's short-term rates. To start with, the media is all going to say this is stimulus. Markets are pricing rate cuts from the central bank and even more aggressive rate cuts from it. And I'm going to show you conclusive proof why it's not using the exact same government bond maturity. This is clearly flight to safety. And that's just what it had been the other two times China's short-term rates had plunged this far, this fast. One of those was in March of 2020 in the Western world's pandemic panic, and the other one was China's stock market crash. Here in 2024, Chinese stocks are up after the bazooka in September, though hardly so much it would explain the dramatic flight to safety that we're seeing showing up here at the front of the Chinese bond curve. If anything, there's a spotlight on Chinese banks, and now it's real estate developers. The banks are in rough shape, we all know that, but developers have been largely forgotten about over the last several months. Maybe it's just coincidence that China's top bank regulator only a couple weeks ago had been asking around to the banks wanting to know what their exposure was to a chopped developer. The same real estate giant that is once again threatening to resort to drastic measures just to stave off a wave of defaults. Remember, China is supposed to have turned a corner. Bond defaults, banking, and real estate crises, these are not supposed to be happening. Bazookas, the Politburo's aggressive tone, have supposedly fixed the world. The stock market said so. So a massive flight to safety, especially right after the Politburo statement earlier this month, doesn't make sense, at least to the media, economists, and other central bankers. Flight to safety in the context of all of this stimulus. It must be the stimulus, right? Well, obviously we can see the difference. And it also plays into everything else that we've been talking about recently, including Brazil and its real and other currency crises that are developing in other parts of the world. It all ties together. A sick and sickening China becomes a very big drag on global economic circumstances, but also financial considerations as well. The worse it might get for China, the more pressure that puts on, say, Brazil's beleaguered currency, its economy, its financial system. Again, Brazil's not the only one. So let's talk about what happened just the last week or so. In a video I did last Monday, focusing on China's falling bond yields, that was mostly the long end. Since then, over the last week, it's the short end that has now taken over the spotlight. China's one-year bond rate, which was 1.37% on December 9th, that's when the Politburo statement came out, had fallen 20 basis points by December 13th. And the media, everybody said that's just the marketplace pricing in more rate cuts from the PBOC. After all, the government said we're gonna shift our policy from prudent monetary policy, which is really interest rate policy, to moderately loose. So here's the marketplace buying the stimulus, except that's not the case, and I'll get to that in just a moment. As of today, so fast forward to today, China's one-year rate is just 0.867%, so well under a full percent, down at a record low, a 50 basis point move in just 2 weeks, with 30 basis points of that coming last week. This is massive flight to safety, huge demand for front-end safe and liquid. And of course, everybody's going to say it's rate cuts, it's the PBOC, but we've seen this happen a couple times before, as I'll go over in this video as well. But like I said, we can tell this is not rate cuts. This is not the PBOC because of how the market reacted just a couple months ago to basically the same thing. When the initial bazooka was announced in September, the market reaction was the exact opposite of what we're seeing here. When the PBOC came out with its press conference on September 24th, they said, we're going to cut a lot of rates. We're going to cut the RRR. We're going to cut the repo rate. In fact, they had cut the 14-day repo rate the day before. And we're going to keep cutting as long as we need to make sure that this works. So the bond market got the message from the government during the bazooka in September that said rates are going to go down. And rates in the marketplace went up. And the market reacted the way you would expect the market to react on a fundamental basis, not always responding and pricing what the central bank is going to do. Economists have to say that. Central bankers have to say that because their worldview depends upon markets not pricing fundamentals, but pricing policies. If markets act independently, then the whole central bank myth falls apart, which is why you keep hearing it all around the world that whenever rates go down, it must be because of some central bank action, either today or down the road. It's not the case. And China is the perfect example, not just in 2024, but all along, that rates are fundamental and central bank policy rates follow the market, not the other way around. And again, when you look at interest rates fundamentally, that makes sense. What the market was saying is that we don't really believe in this stimulus stuff, but you never know. The Chinese government is talking big things, so there's a small chance that this could possibly work. A slight elevation in growth and inflation expectations, even at the short term, like the one-year maturity. So rates backed up, giving the benefit of the doubt to Beijing. But the bazooka didn't last, and it was pretty clear it wasn't going to last. And by the time we get to the middle of October, rates are going down again, not because they're pricing in more stimulus, which is going to lower interest rates from the central bank, which was going to happen because it was going to fail. The markets were pricing that failure. It was the entire Chinese bond curve, the long and the 10-year maturity, that began to really fall on November 18th. More recently, the 5-year maturity, as well as the 2-year, those have been falling from November 27th. That's in tandem with the Brazilian reals crash. And then the 1-year bond maturity, well, that had been falling modestly from the middle of October, moved from around 1.47% to 1.37% by December 9th. Since December 9th, it's been an utter plunge. Not because the Politburo said the central bank is going to cut rates, as we saw. Back in September, the market gave the central bank cutting rates the benefit of the doubt. Rates go up. They go down because of flight to safety, especially at the front end. So the question is, why flight to safety at the front end and why now? All of these developments in China, up to and including the bond market, covered very extensively at Eurodollar University's deep dive analysis. We've got a Christmas sale ongoing, so here's your chance to go deep into the money in macro world. In addition to China, I've covered the Brazil story, other big time developments in the American job market, which is a lot of stuff happening there. And because people always ask, I'm also covering really getting deep into what the hell the Federal Reserve is really doing here. We've also got Eurodollar University's AI, which is incorporated into the deep dive analysis subscription. There's also memberships, a daily briefing. So check out Eurodollar University's Christmas sale at our website. The details are there, eurodollar.university. The problem with all of this is that people are taught, and the message is reinforced everywhere, that interest rates are entirely about central banks and their policies. So if the central bank is cutting rates and market rates happen to be going down, we're supposed to believe the market is pricing the central bank rather than the central bank following what the market is doing. That's not how it works. The market is pricing fundamentals, and those fundamentals finally and eventually make their way to central banks, and then eventually central banks follow the marketplace. But because economists and economics and central bankers depend upon the myth of interest rate policies and being all powerful and all important in the marketplace for interest rates, you never hear the truth, even though it's so easily laid out. And China is the best example of any place. You see this not just in 2024, but the entire last decade plus. Rates go down in China, the situation doesn't get better. Bond market yields go down, anticipating that the situation is not going to get better, and then rates from the central bank just follow along afterward. So on December 9th, the Politburo followed up its bazooka with what was supposed to be update with details, some concrete steps to actually fixing the problem, putting more than just a couple numbers, saying that we're going to borrow trillions of yuan from the bond market in order to do a bunch of stuff we're not going to tell you about. December 9th was supposed to be when the Politburo finally put some pen to paper and said, this is exactly what we're going to do, and this is how we're going to fix China's problems. Instead, they came out with a more aggressive tone, but still mostly just tone. And so you can understand the market reaction to this. And I'm not talking about stocks, I'm talking about real markets. The market reaction to this was, we've seen this before. The bazooka has already fizzled out from September. The rate cuts didn't work. We're getting data from especially Chinese banking system that says It's not working. It's not having any effect. So as the Politburo comes out with expectations high, they're actually going to say how we're going to fix this problem, and they don't. At the very least, it makes sense from a fundamental basis why market rates in China would be going lower. They're not buying this update from the bazooka because there's nothing to buy except more tone. Tone isn't going to fix China's problems. So if it's not that, then of course the mainstream will say it's all about more aggressive rate cuts from the PBOC. The Politburo did direct monetary policy, which again is interest rate policy, not monetary policy. They did direct interest rate policy to become moderately loose after being prudent for the last, ever since 2009, 2010. So maybe that's what the market is pricing, but as I just mentioned, as we just went through, short-term bond rates would react. If there was at all any possibility this was going to work and be actual stimulus, short-term bond rates would rise, not fall. The market was expressing its deep dissatisfaction over the lack of any details because not only has it failed continuously for years, one time after another after another. Remember, the Chinese government did this just last year. Massive amounts of spending. What was sold as massive amounts of spending, it did nothing. The historic housing rescue from earlier this year did nothing. So the market is already highly skeptical of the government to begin with. And then the government comes out with basically nothing new. So of course the market reaction was lower growth and inflation expectation because the market message, the message the market's getting is they don't know what to do. Not only is that pretty sobering all its own, think about what that also says about the scale and the intractability of China's problems to begin with. The government has no idea how to fix it. That's how big the problem has become. So China's in really bad shape, but most of all, the banking system. As also mentioned, there was that article from China Daily that talked about money finance fiscal expansion, which is also a tacit admission, an implicit admission. The banking problem is so big, authorities are at least discussing, if not already planning, about how to work around them. That's another one that would reinforce the lower growth and inflation expectations, lower bond yields, as well as maybe we should consider a little bit more flight to safety tendencies here. Was what does that say about the state of the banking system today, let alone down the road? Chinese banks are cooked with a bunch of bad loans. There's no way to clear them off. But what else is going on in the Chinese banking system? Well, we've got some details, or we got some reports that top Chinese banking regulators are putting out feelers and asking for more information about exposure to real estate developer China Vanke. This is what Bloomberg reported on December 18th. China's banking regulator told the country's biggest insurers to report their financial exposure to China Vanke in a bid to assess how much support the developer needs to avoid default, at least according to people familiar with the matter. The reviews began a couple weeks ago, right around the time we started to see this happen, the big drop in the one-year bond yield, and include holdings of bonds and private debt issued by China's fourth biggest developer by sales. The checks signal continued worries over Vanke, one of the country's few surviving big developers, and one that has the implicit support of the state, as China's years-long property crisis drags on, even though it's supposed to have been fixed time and time again. It's not being fixed. Again, you can see why the Chinese bond market is behaving the way it is. Every time the real estate problem is fixed or the economy is turning a corner, it turns out very quickly that neither of those are true. Of course, you're going to flee towards safety. And these insurance companies had conducted reviews of China Vanke back in March, when all of this stuff really started to get heated, including the bond rally. The bond market, you saw rates rise a little bit after news of this hit. From the early part of March, we saw CNY begin to really drop and take other currencies like Japan's yen with it. India's rupee from March 11th forward. Bond yields in China from March 11th forward, related to fears over if China Vanke, which has been the last of the investment grade rated big developers and the one that was supposed to be in the best shape and best condition because of how much government support it had, if China Vanke is going through this much difficulties, potential liquidity crisis back then, what does that say about the rest of the system? And it's been downhill ever since then. So there's that explanation on top of the macroeconomic disappointment from the fizzled bazooka and the fact that the Chinese government doesn't really know what to do about it. You've got a lot of reasons why there would be lower growth and inflation expectations in the bond market, but also flight to safety. if the implications here behind what the government regulators are doing, soliciting information about the state of exposure, what everybody's exposed to as far as China Vanke is concerned, it also raises another more immediate and potentially urgent risk, which would also explain the high degree of flight to safety that we're seeing in this way, a 50 basis point move in a couple weeks in China's front-end government bond yield. And as I said in the introduction, we've seen this before a couple of other times. The last one was in late March of 2020. At that time, when the rest of the Western world was melting down, China's 1 year went from 1.9% down to 1.23% in a matter of a couple weeks, which makes sense. Not because it was pricing PBOC rate cuts, but because the rest of the world was melting down, flight to safety, perfect sense, fundamentals there. But before that, you got to go all the way back to April, May, and June of 2015. And during that time, China's 1 year bond rate went from 3.11% in the middle of April all the way to 1.7% in the middle of June. So you're talking about 140 basis point reduction in yield in a matter of a couple months. But at one point during that swing, from May 19th until May 28th, you saw a 60 basis point drop in yield less than 2 weeks, just 9 days. And what made it flight to safety and what these dates really correspond with, China's stock market bubble at that time getting to its absolute peak. Shanghai Exchange would top out on June 12th at a ridiculously high rate, and then it would crash from there. So people in China were piling into safe and liquid short-term debt like the 1 year bond in order to ride out what they were seeing as the imminent risk of China's stock market collapse. And they were right to be concerned because as soon as the stock market topped out, it began to collapse. It wasn't so much the stock market that triggered the problems that followed, but it was one more big issue, one more big financial issue on top of a whole host of other ones. So the flight to safety and the condensed flight to safety in the middle of 2015 was about heightened financial risks on top of macroeconomic concerns. Sound familiar? So lower bond yields, whether it be the front end or the long end, that's lower growth and inflation expectations, fundamentals. But at the front end, you're talking more about, especially in these aggressive moves, you're talking more about potential for flight to safety, which is again consistent with lower growth and inflation expectations over the intermediate and longer term. Because if there's a reason to be concerned and fly to safe and liquid instruments, that's going to mean that whatever's causing that is going to really pressure longer run growth and inflation, maybe deflation. So interest rates, bond yields, they make perfect sense. We understand why that's taking place, especially in the context of the last several months where the bazooka has already fizzled out. The government has shown it really doesn't know what to do here. If it did, it would have said so long before today. So not only have the genius stimulus plans, lower interest rates, those don't work anyway. Nothing the Chinese government has worked, and they haven't come up with any new solutions. And anything that they do come up with, it's always vague. Like the bank recapitalization plan that came out with the bazooka in September. Where is that? Instead, China's talking about money finance fiscal expansion, which means how do we get around the banking system? And then you add to this the intrigue, at the very least, of China's top bank regulators going into the banking system and insurance companies and saying, which one of you is exposed to China Vanke? So in China, we've seen this twice before. Once in 2020, once the pandemic lockdowns, and the other time back in 2015 stock market bubble. This one is not about China's stocks, nor obviously are there any lockdowns. So what is it? And the answer is we're still experiencing the downside of the supply shock all over the world. And in China, that means much worse conditions than in most other places. And it's getting to the point that after bazookas and stimulus plans and historic housing rescues, none of which work, it raises the risk of a disorderly unwind, a real bad default. Someplace like China Vanke, they could unleash the very thing that Chinese authorities have been fearing all along. And the very thing that the market in China and elsewhere around the world might actually be getting a sense that it's much more of a probability than anyone would like to admit. Okay, sure, China, Brazil, India, whatever. The U.S. is booming, right? Well, not according to the most recent labor market indications. The job finding rate in the U.S. has utterly crashed, and I talk about that and a couple other things in the video link below. As always, thank you very much for joining me. Check out Eurodollar University's Christmas sale. Huge thank you, Eurodollar University members and subscribers. And until next time, take care.